What most people don't understand is that the most dangerous moves in global markets don't happen when everyone is watching. They happen when one of the world's largest pricing engines goes silent and the rest of the system is forced to trade against shadows. Because when Shanghai goes dark and the onshore Chinese market steps away, what you don't get is stability. What you get is a temporary vacuum in the global liquidity circuit, a window where price discovery becomes distorted, spreads widen quietly, and the dollar system does what it always does in a vacuum. It asserts control. And here's the shocking part, the part that sounds conspiratorial until you realize it's simply mechanical. Roughly 80% to 90% of global trade finance still routes through the dollar system in some form, whether directly through USD settlement or indirectly through dollar-linked banking and offshore dollar funding markets, based on recent BIS-style estimates and widely cited global settlement data. That means even when the world pretends it has moved past the dollar, the world is still borrowing, hedging, and settling inside a USD-shaped cage. So when one major node like Shanghai is absent and global markets continue to operate, you are not watching normal trading. You are watching a global monetary machine reprice risk without one of its stabilizers. And in an 8-day window, that is more than enough time for the machine to do damage. This is not a theory. This is not a mood. This is not a headline. This is a mathematical pattern. A predictable sequence that repeats across centuries, across empires, across currencies, and across political regimes, because it is driven by one thing that never changes. Human institutions overextend credit, then lose control of the price of money. And when the price of money breaks, everything else breaks with it. That's the thesis. The frighteningly boring, terrifyingly reliable thesis. Whenever a system builds itself on a foundation of expanding credit and suppressed rates, it creates the illusion of stability. Then the expansion phase forces debasement, either through overt inflation or through hidden monetary dilution. Then the crisis phase begins when bond markets and currency markets stop believing the official narrative. And finally, the inevitable outcome arrives. Forced repricing, policy panic, and a transfer of wealth from paper promises to hard collateral. It doesn't matter whether the regime calls itself capitalist, communist, democratic, or imperial. The pattern is always the same because the plumbing is always the same. The setup phase always begins innocently. A nation becomes productive, a currency becomes trusted, a central bank becomes the guardian of stability, and credit begins to expand as an accelerant of growth. Then the expansion phase begins. Debt grows faster than productive output. The system becomes addicted to cheap funding. The government and corporate sector learn that deficits don't matter as long as bond yields remain low. The currency's credibility is maintained not through discipline, but through liquidity injections, yield suppression, and the assumption that foreigners will keep financing the party. Eventually, the expansion phase crosses the line into debasement, not always in the crude sense of printing money. Sometimes it's subtler. Financial repression, negative real rates, implicit bailouts, regulatory capture of bond markets, and the quiet monetization of deficits through temporary central bank balance sheet growth. The public is told it's stimulus. The market is told it's liquidity support. But the mechanism is always dilution. Then comes the crisis phase, the moment the system loses control of the price signals. Bond auctions begin to struggle. Bid-to-cover ratios soften. Dealers take down inventory they don't want. Yield curves twist violently. Currency hedging costs spike. The funding markets, the repo market, FX swaps, cross-currency basis begin to scream. And finally, the inevitable outcome phase arrives. It is not always hyperinflation. It is not always total collapse. Sometimes it is an inflationary reset. Sometimes it is a deflationary liquidation. Sometimes it is a currency devaluation disguised as policy reform. But the core outcome is always the same. The system must transfer losses somewhere, and it always transfers them onto the holders of paper claims. That's what makes this 8-day window so dangerous. Because markets are not merely places where people buy and sell. Markets are where the global monetary machine negotiates reality. When one major market is closed, the negotiation becomes asymmetric. And in an asymmetric negotiation, the party controlling the reserve currency has leverage. The dollar system is not merely the US dollar as a piece of paper. It is a global offshore network of dollar liabilities, eurodollars, dollar-denominated debt, FX swaps, synthetic dollars created through derivatives, cross-border lending, corporate bond issuance, sovereign dollar debt, dollar-based collateral chains. It is a system where the world has borrowed dollars to build factories, fund imports, and inflate asset prices. And because the world has borrowed dollars, the world must constantly find dollars to service that debt. That is the hidden choke point. The dollar is not powerful because Americans are uniquely brilliant. The dollar is powerful because the world is structurally short dollars. Every global slowdown, every risk-off event, every spike in volatility, every liquidity shock produces the same reflex. A scramble for dollars, rising dollar funding costs, and forced liquidation of assets to raise USD collateral. The 8-day gap matters because the absence of Shanghai is not just an absence of Chinese traders. It's an absence of a major liquidity provider in key instruments, base metals, industrial commodities, offshore C&H liquidity flows, and the entire ecosystem of hedging that ties Asian trade into global FX markets. When that node is removed, the system becomes more sensitive to dollar squeezes, more prone to volatility spikes, and more vulnerable to narrative-driven repricing. And when the repricing starts, it doesn't start with stocks. It starts with FX. FX is the first alarm bell because FX is where capital flees. FX is where stress transmits. FX is where inflation is imported or exported. FX is where policymakers lose control first, because they can suppress yields for a while, but they cannot suppress the currency forever without draining reserves, destroying credibility, or detonating domestic inflation. In a world built on globalized supply chains, currency weakness is inflation. Currency strength is deflation. That's the core transmission mechanism that most retail investors never grasp. If the dollar surges, it tightens global financial conditions. It crushes emerging market balance sheets. It raises the real burden of dollar debt. It forces central banks abroad to either hike rates defensively or accept currency depreciation and imported inflation. If the dollar weakens, it loosens global conditions, fuels commodity reflation, and inflates asset prices. So the dollar is not just a currency. It is a global interest rate lever. And when Shanghai goes offline, the system becomes more dependent on the dollar's direction because the world loses a major source of marginal liquidity and marginal price discovery. This is the part that is never said out loud. Modern markets do not clear through buyers and sellers. They clear through collateral and leverage. The world is not trading fundamentals. The world is trading funding conditions. And funding conditions are set by the cost of dollars. That is why the real market is not the S&P 500. The real market is the U.S. Treasury market. Because U.S. Treasuries are not merely government debt. They are the backbone collateral of the entire global financial system. Treasuries sit under repo agreements, under bank reserves, under derivatives margin, under sovereign wealth portfolios, under insurance balance sheets. Treasuries are the risk-free asset that allows leverage to exist. So when yields move, the world moves. When yields rise, collateral values fall. Margin requirements rise. Leverage is forced to unwind. Risk assets sell off. Credit spreads widen. Volatility increases. And then the dollar strengthens as global investors scramble for the most liquid collateral in existence. This is why bond auctions matter more than earnings reports. A weak auction is not just a weak auction. It is a signal that the marginal buyer is stepping away. It is a signal that dealers are being forced to warehouse more duration risk. It is a signal that the system is choking on supply. And the U.S. is now a machine that produces bond supply continuously. The Treasury issues. The primary dealers absorb. Foreign central banks and global funds recycle. The Fed occasionally stabilizes. And the system survives as long as demand remains deep enough to absorb the issuance without yields rising too fast. But that balance is fragile. Because yields are not just a number. They are a gravity field. If yields rise too far, too fast, the entire financial structure begins to wobble. Not because the government can't pay. Governments can always print. But because the market begins to demand a higher risk premium for holding the paper. And once that premium begins to rise, it becomes self-reinforcing. Higher yields mean higher interest expense. Higher interest expense means larger deficits. Larger deficits mean more issuance. More issuance means more supply pressure. More supply pressure means higher yields again. That is the spiral. That is the point where control begins to slip. Now this is where history becomes brutal. Because every time a nation reaches the point where it must choose between defending the currency and defending the debt market, it chooses the debt market. Always. Because a collapsing bond market is a collapsing government. And that brings us to the first historical case study that proves the mechanism with surgical clarity, the United States in 1971 through the late 1970s. The setup phase was post-World War II. Bretton Woods. The dollar was the anchor. The U.S. held the gold. Other currencies were pegged. The system worked because America was productive, industrial, and trusted. The dollar was as good as gold because it was redeemable into gold at $35 an ounce. But then came the expansion phase. Vietnam. Great society spending, persistent deficits. The U.S. began exporting dollars. Foreign nations accumulated dollar reserves. Those reserves were supposed to be as good as gold, but they were only as good as America's willingness to honor redemption. And then came the debasement phase, hidden at first. The U.S. did not have enough gold to cover the claims. The world began to notice. France and others began demanding gold shipments. The London gold pool struggled. The pressure built. By 1971, the system reached its crisis phase. The U.S. faced a choice: raise rates brutally, cut spending and defend the gold peg, or break the peg and preserve domestic policy flexibility. Richard Nixon chose the only politically survivable option, the Nixon shock, the closing of the gold window. That moment was not merely a political decision. It was the moment the world officially transitioned from a currency system backed by a hard constraint to a currency system backed by credibility and military-industrial enforcement. And the inevitable outcome phase came quickly. The dollar devalued. Inflation surged through the 1970s. Oil shocks compounded the issue. Wage price spirals took hold. Bond yields exploded upward because bond investors demanded compensation for inflation risk. Volatility rose. The Fed lost credibility. The system began to fracture. And then came the final brutal reset. Paul Volcker. Volcker did not fight inflation with speeches. He fought it with a sledgehammer. Rates were driven toward levels that would be politically impossible today. The cost of money was raised until the economy broke. Unemployment surged. Recession hit. But the dollar stabilized, and the inflation psychology cracked. That is the full pattern in one cycle. Setup, Bretton Woods credibility. Expansion, deficit spending and global dollar export. Crisis, gold convertibility collapse in 1971. Outcome, inflation, soaring yields, and ultimately a violent monetary tightening to restore credibility. The key lesson is not that the U.S. won. The key lesson is that once the debasement phase begins, the crisis phase is not optional. It is scheduled. The system cannot avoid the reckoning. It can only choose how it arrives. And notice what happened to gold during that era. Gold was freed from its peg. It surged. It became the pressure valve. It became the honest thermometer of currency debasement. It wasn't gold going up. It was the dollar going down. That same dynamic exists today, but with a far larger and more leveraged global system. Now consider the second case study, even more violent in its implications. Britain and the collapse of sterling's imperial role in the mid-20th century, culminating in the 1967 devaluation and the long retreat from reserve currency dominance. The setup phase was the British Empire. Sterling was the global trade currency, London was the financial center, Britain financed global commerce, sterling reserves were held across colonies and trading partners. The pound's credibility was tied to Britain's industrial and naval power. Then came the expansion phase, 2 world wars, massive borrowing. The empire became expensive to maintain, debt grew. Britain's productive capacity weakened relative to the U.S. The country increasingly relied on external financing and on the assumption that sterling would remain trusted. Then came the debasement phase. Britain attempted to maintain the pound's prestige while running persistent deficits and facing balance of payments problems. It tried to defend an overvalued currency peg through policy measures, austerity, and reserve depletion. It tried to preserve the illusion of strength. But the crisis phase arrived because the market is not sentimental. Speculators attacked the pound repeatedly, reserves drained. The Bank of England fought to defend the peg. Yet the more Britain defended sterling, the more it weakened domestic growth and deepened political instability. It became trapped. And in 1967, the inevitable outcome came: devaluation. The pound was officially devalued by roughly 14%. That devaluation was not merely a technical adjustment. It was a confession that the empire's monetary foundation could no longer support the claims placed upon it. The world learned a lesson. Reserve currency status is not a permanent entitlement. It is rented, and the rent is paid in discipline. Britain lost reserve dominance not in one day, but through repeated cycles of stress, devaluation, and loss of credibility. Each defense of sterling drained more reserves. Each policy attempt to preserve the illusion weakened the real economy further. Eventually, the market forced the reset. And again, the pattern was identical. Setup, sterling trust. Expansion, war debt and overextension. Crisis, repeated balance of payments breakdowns. Outcome, devaluation and the gradual migration of global reserve power to the dollar. Here's what makes that case study terrifying in 2026 terms. Britain did not collapse because it lacked intelligence or institutions. It collapsed because its liabilities exceeded its productive base. It collapsed because it tried to maintain a global monetary role while its domestic fundamentals no longer justified it. And the market always finds that mismatch. This is the part people refuse to say about the modern U.S. system. The U.S. is still the reserve currency issuer. The U.S. still has the deepest capital markets. The U.S. still has unmatched military reach. But the liabilities have grown enormous, and the bond market is now the battlefield where confidence is negotiated daily. The U.S. Treasury market is now issuing in a world where foreign central banks are not accumulating reserves at the same pace. The Fed is no longer in emergency QE mode. The marginal buyer is less reliable, and the private sector demands yield. That is not a political statement, that is a funding reality. And the funding reality determines everything else: FX, inflation, risk assets, and the behavior of gold and silver. This is where precious metals stop being barbarous relics and start being diagnostic instruments. Gold is not just an asset. Gold is the inverse of confidence in paper promises. When real yields are negative, gold tends to rise because holding currency becomes a guaranteed loss. When the system begins to smell like debasement, gold absorbs that fear. Silver is even more unstable because it sits at the intersection of monetary metal and industrial commodity. It has a split personality. It trades like a leveraged version of gold during monetary stress, but it also trades like an industrial input during growth cycles. Now, that makes it violent. That makes it prone to sharp squeezes and brutal drawdowns. And then there's the real secret, the difference between paper metals and physical metals. Most investors think gold and silver are just prices on a screen. They are not. The futures market is a paper claims market. It is dominated by leverage, hedging, and speculative positioning. It can create enormous synthetic supply through contracts. But physical metal has constraints. It has delivery timelines, it has vault inventory, it has refinery throughput, it has shipping bottlenecks, it has premiums, it has real-world scarcity. So when stress hits the system, what happens is not merely that the price rises. What happens is that the paper market begins to detach from physical reality. Futures can be sold aggressively to suppress price, but physical demand can quietly drain inventories. Premiums rise, coins and bars go out of stock, delivery times extend, lease rates change, and suddenly the market begins to realize the truth. You cannot print metal. That's when the pressure valve starts to hiss. And the most dangerous moment is when liquidity tightens while physical demand increases. Because tight liquidity strengthens the dollar, which pressures commodities lower in paper terms. But systemic fear pushes investors into physical collateral. The result is a war between paper pricing mechanisms and physical scarcity. This is not theoretical. We have seen it repeatedly. Inventory drawdowns at major exchanges, backwardation flashes, retail premiums exploding even when spot prices fall, and COMEX-registered stock debates becoming mainstream. The entire system is a confidence game layered on top of real supply constraints. Now bring this back to Shanghai. Shanghai is not just an equity market. It is a physical commodities hub. It is a gold market hub. It is a center for industrial demand expectations. It is a reference point for regional liquidity. When Shanghai closes, it removes a major signal. It removes a major stabilizer. It leaves global pricing more dependent on Western futures markets and offshore liquidity conditions. And offshore liquidity conditions, at this moment, are being dictated by the dollar system's tightening pulse. The world is sitting on a razor's edge where inflation and deflation are not opposites. They are sequential phases. In the short term, a dollar squeeze creates deflationary pressure through liquidation. Risk assets fall, commodities fall, credit spreads widen, volatility spikes. Everyone sells what they can, not what they want to sell. But the policy response to deflationary liquidation is always inflationary. Central banks respond with liquidity, governments respond with fiscal spending, debt issuance increases, the currency absorbs the adjustment. So the system oscillates. Deflationary shock, inflationary response, tightening then easing, liquidity drain then liquidity flood. And each oscillation weakens the currency's long-term credibility because the market learns the pattern. And that is why this is boring but terrifying. Because you can already see the outlines of the next move forming in the funding markets, in the bond auctions, in the yield curve distortions, in the FX basis shifts, and in the subtle premium behavior of physical metals. This 8-day window is not a random calendar quirk. It is a temporary break in the global price discovery machine, occurring at a time when the world is hypersensitive to dollar funding stress and hypersensitive to Treasury supply absorption. And when the machine re-engages, the repricing won't start with headlines. It will start with spreads, with repo, with bid to cover, with the dollar's momentum, with the cost of hedging, with the quiet stress in currencies that cannot afford a stronger USD. Because the dollar system doesn't need permission to tighten. It tightens automatically when risk rises, and that is what makes the reopening so dangerous. The market will not simply resume trading. It will reconcile 8 days of offshore repricing, 8 days of currency positioning, 8 days of bond yield movement, 8 days of volatility shifts, and 8 days of physical demand behavior. When that reconciliation happens, the system will reveal whether we are still in the expansion phase or whether the crisis phase has already begun. And the first place you will see it is not the stock market. You will see it in the dollar, you will see it in yields, and you will see it in gold and silver behaving like the only honest witnesses left in a system built on paper. And when gold and silver start acting like the only honest witnesses left, that's not a bullish signal. That's the system confessing that paper credibility is thinning. To understand what happens next, when markets reopen and the global machine tries to reconcile an 8-day liquidity distortion, you need one final historical proof point. Not because history repeats in the poetic sense, because it repeats in the plumbing sense. The pipes are the same. The incentives are the same. The political reactions are the same. The third case study is the Asian financial crisis of 1997 to 1998. because it demonstrates something most investors still misunderstand. Currency collapse is not a local event. It is a chain reaction through dollar liabilities. The setup phase was the early 1990s miracle narrative. Thailand, Indonesia, South Korea, Malaysia. Rapid growth, capital inflows, export booms. Many of these economies were effectively pegged to the US dollar or managed within narrow bands. The peg created confidence. The peg attracted foreign capital. The peg lowered borrowing costs. It looked like stability, but the expansion phase was built on the same poison that always fuels booms: leverage and mismatched funding. Corporations and banks borrowed in dollars because it was cheaper. They lent domestically in local currency. They built balance sheets that only worked if the exchange rate stayed stable and global liquidity remained abundant. The growth story justified everything. Real estate surged, credit expanded, foreign inflows accelerated. Then came the debasement and overextension, not through printing money, but through the quiet accumulation of external liabilities. Current account deficits widened, short-term dollar debt piled up. The system became dependent on rolling funding, on constant refinancing, on the assumption that foreign capital would always return. And then the crisis phase arrived the way it always does, not as an announcement, but as a funding problem. Speculators attacked the Thai baht in 1997. The central bank burned reserves trying to defend the peg. But reserves are finite, and markets are infinite. Thailand was forced to abandon the peg in July 1997. The baht collapsed. The collapse instantly turned dollar debt into an exploding liability. What was manageable at one exchange rate became fatal at another. Then the contagion spread. Indonesia's rupiah imploded. South Korea's won plunged. Corporate balance sheets shattered. Banks became insolvent. Credit markets froze. IMF rescue packages arrived, but with austerity conditions that worsened recessionary pressures. Capital fled. And suddenly, the Asian miracle became an Asian liquidation event. The inevitable outcome was not just devaluation. It was forced restructuring, political upheaval, and the transfer of assets from local hands to foreign capital at distressed prices. It was a sovereign lesson in what happens when you build growth on external dollar liabilities. And the most important detail, the one that maps directly to today, is that the crisis was not caused by local incompetence. It was triggered by the dollar strengthening and global liquidity tightening. As the US dollar rose and US rates firmed, the ability to roll dollar debt evaporated. The entire system, built on cheap dollar funding, collapsed when the cost of dollars rose. That is the mechanism in its purest form. The dollar becomes scarce, and everything leveraged to the dollar breaks. Now bring that back to the present, because the modern global system is not merely dollar dominant, it is dollar dependent. The world is sitting on a mountain of dollar-denominated liabilities: sovereign debt, corporate debt, synthetic exposure through FX swaps, and derivative structures that create invisible dollar obligations. When people say the dollar is weaponized, they miss the deeper truth. The dollar doesn't need to be weaponized. The dollar is the oxygen tank. When oxygen is restricted, everyone panics. So let's apply the mechanism step by step to the current system. Not emotionally, not politically, but mechanically. The setup phase was the post-2008 world. Zero rates, quantitative easing, the Fed backstopping markets, the ECB and BOJ doing the same, a decade of suppressed volatility, a decade where the price of money was artificially cheap and credit could expand without consequence. The dollar system became the global base layer for carry trades, for emerging market borrowing, for corporate refinancing, for speculative leverage. The world learned that liquidity was permanent. That belief was the foundation. Check. Then came the expansion and debasement phase. Not only did debt expand, but it expanded at the wrong maturity profile. Governments issued more. Corporations issued more. The private equity machine issued more. The world built portfolios on duration exposure and low volatility assumptions. Meanwhile, central banks expanded balance sheets to levels that would have been unthinkable in prior decades, and fiscal authorities normalized deficits as a permanent feature of governance. The debasement wasn't always visible in CPI prints at first. It was visible in asset prices, stocks inflated, real estate inflated, credit spreads compressed, junk bonds traded like safe assets. The system was quietly telling you that money was being diluted. Verified. Then came the transition toward crisis, and this is where most investors get trapped because the crisis phase doesn't begin with a crash. It begins with bond yields refusing to behave. Bond yields are the lie detector. When the market stops believing inflation is transitory, the term premium rises. When the market stops believing deficits are temporary, the term premium rises. When the market stops believing central banks can painlessly cut rates without consequences, the term premium rises. And term premium is deadly because it's not just about inflation expectations, it's about trust. Once the bond market demands extra compensation for uncertainty, the cost of funding the entire economy rises. Mortgage rates rise, Corporate borrowing costs rise, government interest expense rises, credit spreads widen, refinancing becomes harder, and the rollover wall begins to appear, undeniable. Now we arrive at the heart of the current machine, debt rollovers and Treasury auctions. The U.S. Treasury is issuing continuously, and the market is forced to digest it. The bid-to-cover ratio becomes a quiet stress indicator. A healthy auction shows deep demand. A weak auction shows the opposite. Primary dealers forced to absorb supply, foreign buyers stepping back, and yields rising to clear the market. When that happens repeatedly, the message is clear. The system is demanding a higher price for capital. Check. And then the funding markets begin to tighten. Repo rates become unstable. Dealers demand higher haircuts on collateral. The cost of borrowing treasuries in the repo market rises, signaling collateral scarcity or balance sheet constraints. Swap spreads start behaving erratically, indicating stress between cash treasury markets and derivatives markets. The basis trade, the leveraged strategy where hedge funds exploit small price differences between treasury futures and cash treasuries, becomes a potential fault line. Because the basis trade is not smart arbitrage, it's leveraged funding. It depends on stable repo and stable collateral conditions. When volatility rises, margins rise. When margins rise, leveraged players unwind. When they unwind, they sell treasuries or dump futures, pushing yields higher. This is how you get sudden yield spikes that look irrational. They are not irrational. They are forced deleveraging, verified. Now add the global FX layer, because this is where the dollar system tightens the noose. When U.S. yields rise, the interest rate differential pulls capital toward the dollar. When global volatility rises, investors seek dollar liquidity. When global growth weakens, dollar debt becomes harder to service. This is how you get currency stress in places that shouldn't matter until they suddenly matter a lot. You see it first in the yen, because Japan is the funding currency for global carry trades. If USD JPY moves violently, it's telling you that leveraged global positioning is being repriced. You see it in the euro through widening spreads and rising hedging costs. You see it in emerging markets through reserve depletion and sudden rate hikes. You see it in China through the offshore CNH market, where pressure can build even when the onshore market is managed. FX is the transmission line. It transmits the tightening instantly, undeniable. And here is the brutal irony. Dollar strength is deflationary globally, but it is inflationary locally for anyone importing commodities, energy, or food. That is how you get simultaneous inflation and recession risk. That is how you get stagflation-like stress without calling it stagflation. A strong dollar tightens financial conditions. It breaks foreign balance sheets. It forces central banks to defend their currencies by hiking rates into weakness. That destroys domestic demand. That creates unemployment pressure. But it also raises import costs and energy costs. So the public feels inflation while the economy feels contraction. That is the crisis stage. Check. Now layer in the liquidity cycle. Liquidity is not money printing. Liquidity is the ease with which balance sheets can expand. Liquidity is the willingness of dealers to make markets. Liquidity is the stability of collateral chains. Liquidity is the confidence that you can sell without moving price too much. When liquidity dries up, volatility spikes. And volatility is not just a measure of fear. Volatility is a margin call engine. When volatility rises, risk managers reduce exposure. When exposure is reduced, selling accelerates. When selling accelerates, volatility rises further. This is the reflexive loop that destroys markets. And when it happens, it doesn't start in equities. It starts in rates and FX, verified. Now you understand why the 8-day Shanghai gap matters. Because while one major node is closed, offshore markets continue repricing risk. When Shanghai reopens, it must reconcile not only price changes, but collateral changes, funding changes, and hedging changes. That reconciliation is where the shock happens, and the shock expresses itself through currency moves first. If CNH weakens sharply on reopening, that's not just China weakness. That is the market pricing global demand deterioration and capital outflow pressure. If CNH strengthens sharply, that may not be strength either. It may be intervention, tightening, or forced stabilization that drains domestic liquidity. Either way, the currency becomes the battlefield. Undeniable. Now we get to the metals, because metals are where the system reveals its final truth. Gold is the stress valve for sovereign credibility. When real yields fall, gold rises. When the Fed pivots, gold rises. When bond markets begin doubting fiscal discipline, gold rises. When currency debasement becomes visible, gold rises. But gold is also suppressed by the paper market when liquidity is tight, because paper gold can be sold aggressively to raise dollars. Futures contracts can create synthetic supply instantly. That is why you sometimes see gold selling off during panic, even when the fundamentals scream buy. It's not a contradiction, it's forced liquidity extraction. Gold becomes the ATM. Check. Silver is even more dangerous because it has less depth and more industrial linkage. Silver is the metal that can be crushed in a deflationary liquidation and then explode upward in the reflationary response. It is a volatility instrument disguised as a commodity, and silver has a supply constraint that markets love to ignore. Mine supply does not respond quickly to price. Refining capacity is not infinite. Industrial demand, especially in electronics and solar, does not disappear overnight. And when investment demand spikes, the market can go from surplus to shortage faster than the paper traders can comprehend. Verified. Now focus on the paper versus physical mechanics, because this is where the trap is set. Paper gold and paper silver are primarily futures and unallocated accounts. They are claims. They are promises. They trade on leverage. They can be expanded and contracted like credit. Physical metal is not like that. Physical metal requires delivery. It requires bars. It requires transport. It requires vault inventory. So when stress rises, two markets begin to diverge. The paper market can show weakness because leveraged traders sell. But the physical market can show tightness because real buyers demand delivery. Premiums rise even if spot prices fall. Coin shops run out. Delivery times stretch. Vault inventories draw down. Registered metal on exchanges becomes the focal point because registered is what can actually be delivered. When you start seeing persistent inventory drawdowns, rising lease rates, and widening premiums, you are seeing the system's credibility fracture in real time. Undeniable. And this is the ultimate tell. When physical demand stays strong while paper prices are pressured, it means the public is not buying the narrative. It means real money is leaving the paper casino and moving into collateral that cannot be diluted. Gold and silver do not merely hedge inflation, they hedge policy panic, because policy panic is the inevitable outcome stage. When the system begins to break, policymakers will not tolerate liquidation. They will inject liquidity. They will cut rates. They will intervene in bond markets directly or indirectly. They will pressure banks to absorb issuance. They will change regulations. They will redefine what stability means. And the moment they do, the market will understand that the debasement is not ending. It is accelerating. Check. Now look at the US specifically. The United States is not immune to this pattern. The US is simply the last domino because it issues the reserve currency. That gives it time. It does not give it immunity. If auctions weaken and yields rise, the Treasury's interest expense grows. If interest expense grows, deficits widen. If deficits widen, issuance increases. If issuance increases, the market demands higher yields, and the spiral tightens. At some point, the Fed faces the same choice every empire faces: defend the currency through tight policy, or defend the bond market through liquidity. And defending the bond market is politically easier. Verified. This is why the reopening matters so much. When global markets reopen, the reconciliation between offshore dollar conditions and onshore Asian liquidity conditions will show whether the next phase is beginning. You will see it in the dollar index. You will see it in USD CNH. You will see it in US 10-year yields. You will see it in swap spreads. You will see it in repo stability. You will see it in the volatility index and credit spreads. And if those indicators move together, stronger dollar, rising yields, widening spreads, you are watching the crisis phase lock into place. Undeniable. So what do you do with this? First, you stop listening to narratives and start watching plumbing. Watch Treasury auctions. Watch bid to cover. Watch indirect bidder participation. Watch whether primary dealers are forced to take down supply. Watch the term premium. Watch real yields, because real yields tell you whether the market believes policy is credible. Watch repo markets. Watch SOFR. Watch whether funding rates spike unexpectedly. Watch the basis trade pressure points, because that's where forced liquidation begins. Watch FX, especially USD JPY and USD CNH, because those are the pressure gauges of global leverage. Watch credit spreads, because credit is where the economy confesses. And watch gold and silver not for the price alone, but for the behavior. Do premiums rise while paper sells off? Do inventories drain? Does physical demand stay relentless even when futures are smashed? That divergence is the signal. Check. And above all, understand the trap. Most people become the liquidity exit. They hold risk assets during the calm phase, they ignore the bond market warnings, and then they panic, sell into the forced liquidation phase, right when the smart money is positioning for the policy response. Don't be the liquidity exit. Verified? Now the final warning must be said plainly, because it is the sentence that every cycle tries to erase. This time is not different. Not because America is weak, not because the dollar is ending tomorrow, but because the mechanism does not care about your optimism. It does not care about American exceptionalism. It does not care about the fantasy that tech will save us. It does not care about the modern belief that policymakers can always engineer a painless outcome. Those are comforts, not strategies. Undeniable. The practical takeaway is simple. Stop thinking in terms of headlines and start thinking in terms of funding stress. Position your mind around liquidity cycles. Understand that the dollar tightens globally when volatility rises. Understand that bond yields are not just rates, they are the price of confidence. Understand that gold and silver are not speculative toys. They are the final audit of the system. If you want to survive what comes next, you track the indicators that the system cannot fake. Auction demand, real yields, repo stability, FX basis stress, and physical metal tightness. And when those signals align, you don't wait for permission from the media to act. You move before the crowd realizes the door is closing. Stay close, because the next breakdown is not going to be explained correctly in real time. In the next video, we'll walk through exactly how this machine was built, why the dollar shortage is structural, and what the next stage looks like when policymakers finally choose the bond market over the currency. Because they always do. And when they do, the repricing is not a surprise, it's a verdict. So as markets reopen and the dollar system recalculates the world's balance sheet, ask yourself one question. When the liquidity disappears, will you be holding paper promises or hard collateral?